Are we looking at the market's most misunderstood, undervalued tech play, or an extremely dangerous value trap?
Yeah, that is the million-dollar question today, isn't it?
It really is. Welcome to the deep dive, everyone. Today is Thursday, April 16th, 2026.
And if you are listening right now and you've been watching the ticker tape today, you already know why we're asking that.
Right, because we are looking at a stock that is just completely defying gravity right now.
Truly defying it.
So our mission today is to just tear apart the financials, the technicals, and, the competing narratives to figure out what is actually happening under the surface.
And before we get too deep in the weeds, just a quick reminder. This is a natural human debate and analysis of the data we have.
Right, absolutely no financial advice here.
Exactly. No financial advice. We're just looking at both the bull and the bear arguments objectively to understand the mechanics of this asset.
Spot on. And hey, before we jump in, please like the video, subscribe to our YouTube channel, and it's compulsory that you leave your feedback in the comments. We want to know your take on this.
Yeah, we definitely want to hear from you.
Okay, let's unpack this. We are talking about WeShop Holdings Ltd. Ticker is WSHP.
And the headline here is just extreme volatility.
Right. It's currently trading around $19.55. That is a massive, a 137.83% surge from its previous close of $8.22.
Yeah, and it even touched almost $41 in recent sessions.
Which is insane. To give you a sense of how wild this ride has been, the 52-week range has a floor of $4.95, but a staggering high of $250.
$250, just let that sink in.
I know, right? And right now, its market cap sits at approximately $192 million. But the thing that's really breaking the scanners today is the volume.
Oh, absolutely. The volume is the undeniable fingerprint of what's going on here.
Okay, so the numbers are staggering. We're seeing a volume spike of roughly 16.6 million shares traded today.
16 million. And their average volume is what?
Just over 122,000. Yeah, so to put that into perspective, that is like a quiet, sleepy town of 100 people suddenly waking up to find 16 million tourists trying to buy coffee at the exact same time.
That is a great way to put it. The infrastructure of the stock is just being completely overwhelmed by attention.
So how does a microcap stock suddenly absorb that kind of tidal wave?
Well, what's fascinating here is the composition of that volume. You have to ask, who is actually doing the buying?
Right, because not all volume is the same.
Exactly. You've got retail volume, everyday people on their phones, and then institutional volume, the huge hedge funds and banks.
So who is driving this?
Our data reveals this massive surge was triggered heavily by retail buying, right around a $5.85 pivot point.
Just retail traders smashing the buy buttons.
Smashing it. That's what ignited this rally.
So if you're listening right now, you see 137% green ticker, you probably have that FOMO itch, right? Like you're missing out on easy money. But what about the big players? Are the major institutions feeling that FOMO?
Not even a little bit. In fact, that's a crucial piece of the puzzle here. It is an absolute institutional ghost town.
A ghost town, really?
Yeah, to give you some context on how extreme it is, major players like Morgan Stanley and UBS, institutions that move markets, they hold a measly 1,963 shares combined.
Wait, less than 2,000 shares combined?
Literally less than 2,000.
For two of the biggest banks in the world, that's like finding loose change in the couch cushions.
Exactly. It's virtually nothing. They're sitting this one out entirely.
Wow.
And meanwhile, just as a side note on who's actually making money, we noted recent proceeds of about $2 million from employee-related performance incentive grants back in March of 2026.
Interesting. So insiders got some liquidity recently.
Right. So retail is piling in, institutions are absent, and insiders got paid.
So if retail's pouring in, but the smart money, like Morgan Stanley, refuses to touch it, they must see a massive red flag.
They definitely see something the retail crowd is ignoring.
So let's look under the hood. Let's look at the financial reality check. How much money does WeShop actually make to justify a nearly $190 million valuation?
Right, because eventually the hype fades and you have to look at the actual business.
Okay, looking at the trailing 12 months, the TTM, and the 2025 summary data, honestly, I am having a hard time wrapping my head around these numbers.
They are pretty rough.
Let's round them so our brains don't glaze over. Their annual revenue is incredibly low. It's sitting at just over $810,000.
Which is tiny for a public company.
Preeny. And their net income is a massive loss. They are losing roughly $11 to $12 million a year.
Yeah, translating to an EPS of negative $1.37 to negative 145.
Wait a minute, my local neighborhood bakery generates more revenue than this $190 million company.
It's true.
How does a company operate when it spends $12 million to make $800,000?
It's a stunning disconnect. And to understand how precarious this really is, we have to talk about the balance sheet and cash flow.
Right, cash is oxygen.
Exactly.
Yeah.
If you run out of cash, the business dies, no matter how good the idea is. And WeShop is facing a critical cash crunch.
How bad is it?
They have total cash on hand of just about $102,000.
$102,000 for a publicly traded company.
Yes, it's practically empty. And against that tiny cash position, they have a very high debt-to-equity ratio of roughly 173%.
Ouch.
But the real disaster is hidden in the current ratio. That tests if a company can pay off its immediate short-term obligations using easily accessible short-term assets.
Right, day-to-day survival.
Exactly. WeShop's short-term assets are sitting at £166,000. But their short-term liabilities bills they have to pay very soon are £8.8 million.
That is terrifying. How do you even keep the lights on? They don't even come close to covering what they owe.
Mechanically, they're essentially living on credit cards, hoping a new card arrives before the old ones default.
Wow.
And factor in a free cash flow of negative $3.48 million, it shows they're burning cash incredibly fast.
So when you put all that together, what does it say about the current price of $19.55 a share? Because the stock price isn't reflecting the bank account.
It says the underlying business is in deep distress. The stock is trading purely on speculation.
Just pure momentum.
Right. We use valuation metrics like price to sales, the PS ratio, and price to book, the PB, to determine if a price is fair. WeShop has a PS ratio of over 81.
81.
Yeah, and a PB of almost 18. You are paying a massive premium for every single dollar of actual sales they generate. It is screaming highly overvalued.
Okay, so if the financials are this much of a nightmare, why are everyday people buying it today?
That's the power of narrative.
Right. There has to be a story driving those 16 million shares. And here's where it gets really interesting. There is a bull case out there.
There always is when a stock runs 137% in a day. What's the narrative?
According to our sources, the bullish argument hinges on WeShop being a microcap, community-owned platform. They boast this unique model called ShareBack.
ShareBack, right?
Yeah, it's designed to drive user adoption by literally giving shares of the company back to the users who shop on the platform, turning customers into owners.
It sounds great on paper.
It does. Plus, the bulls have a very shiny metric. They show high growth in UK revenue, up a staggering 428%.
And that right there is exactly how an intoxicating narrative is built.
Yeah.
You take a populist concept like community ownership and pair it with triple-digit growth.
Yeah.
But this points to textbook meme stock behavior.
Meme stock behavior. What do you mean by that in this context?
It means retail investors are buying a feeling, not a business. The core argument against this stock isn't whether ShareBack is fun. It's about the mechanics.
The reality of the numbers.
Right. The massive disconnect between an $800,000 revenue stream and a $190 million market cap.
Make that make sense.
Mechanically, if you are giving away shares to people just for shopping, you are constantly diluting existing shareholders.
Slicing the pie thinner and thinner?
Exactly, to artificially buy user growth.
That makes total sense. You aren't generating cash, you're giving away equity. But what about that 428% growth? That sounds impressive.
This is why retail traders get trapped. This is the trap.
How so?
They buy the headline that says 428% growth without looking at the baseline. Think of it like a lemonade stand.
Oh, I love a good analogy.
If you make $100 your first year and grow by 400% the next year, you have $500. Incredible explosive growth, right?
Yeah, technically.
But you still only have $500.
Which doesn't help much if you owe the bank $8.8 million.
Precisely. 400% growth on practically zero revenue still doesn't generate the real dollars needed to cover that massive liability pile.
Wow. That puts it perfectly into perspective. Growth on practically nothing is still basically nothing when the debt collector knocks. So we've got this fundamental tug-of-war, the ShareBack dream versus the balance sheet nightmare. Let's shift gears to the technical charts.
Let's do it.
I'm looking at the momentum indicators from the sources, and it looks like a mess of conflicting signals. We've got this insane 137% surge today, But some broader trend lines look negative.
They do.
Can you translate what the technicals are actually doing here?
Absolutely. The charts are where the emotion of the retail buyer meets the reality of price action. Let's look at the RSI, the Relative Strength Index, and the MACD.
Okay, let's start with the RSI.
Think of the RSI like a car's RPM gauge. It tells us how hard the engine is working.
Got it.
Before today's spike, the 14-day RSI was neutral, almost oversold. But because of this surge, the engine is redlining. It shot up to the mid-40s and is rapidly approaching overbought levels.
And what about the MACD?
If the RSI is the RPM gauge, the MCD is the GPS. It tells us the overarching direction the car is traveling.
Regardless of how hard the engine is revving.
Exactly. And the MACD is still generally flashing a sell signal, sitting at negative 0.17 to negative 0.65.
So even with today's surge, the overarching GPS says we're heading down the mountain.
Yes. There are some short-term buy signals from the recent pivot bottom, but the broad trend remains troubled.
So the engine is screaming, but we are heading downhill. If you're treating this, where are the boundaries? Where's the floor and the ceiling?
You have to map out the battlefield. Support is the floor, where buyers historically step in. The ultimate floor sits at $4.95.
The 52-week low.
Right. There is another closer layer of support at $14.32.
Okay, so that's the floor. What about the ceiling? Why is it hard to break higher?
That ceiling is resistance. Immediate resistance is looming at $22. But the real structural resistance is at the 200-day moving average, which is $39.13.
Let me make sure I understand resistance. Is it basically a ceiling made of trapped buyers?
How do you mean?
Like anyone who bought months ago at $39 watched it plummet, and now that it's moving back up, they are just desperately waiting to hit sell and break even.
That is the perfect analogy. Resistance isn't a magical line. It's human psychology. It's millions of shares held by exhausted people who just want out.
Right.
And this highlights the core technical conflict. We have a strong uptrend in the very short term, entirely driven by speculative momentum.
FOMO.
Yes, but it's battling a strong downtrend in the long term.
So even with a huge green day, the long-term trend drags it down.
Exactly. The weakness signals are glaring. Despite today's surge, the stock is still trading below its 50-day moving average of 1957.
It's just barely below it, but still below.
Right, and well below the 200-day moving average of 59.90. The current strong sell signals suggest profit-taking levels are approaching fast, near $22.
So what does this all mean for someone watching the ticker? Is this a genuine breakout or a dead cat bounce driven by hype?
If we connect this to the bigger picture, technical models suggest it's far more likely a speculative bounce within a broader decline.
A dead cat bounce, basically.
Right. The models indicate gravity will likely take over, returning toward the lower part of its falling trend, around $5.73.
Unless it can hold a breakout.
Yes, unless it can maintain its breakout above $8.84. But long-term, the forecast is highly bearish, predicting a drop to $5.52 by year-end 2026.
Man, the models are firmly betting on gravity, but momentum can only carry a stock so far before it needs a fundamental reason to justify the price.
Oh, absolutely.
And according to our sources, there is a very loud ticking clock here.
The catalyst is coming.
Tuesday, April 28, 2026. The Q4 and full year 2025 earnings report.
That is the moment of truth.
Right, where the ShareBack narrative meets the actual balance sheet in front of the entire market.
It's the ultimate collision point. You can build a great narrative on social media, but you cannot hide from a formal earnings report.
The numbers don't lie.
On April 28th, management has to detail exactly how much cash is left. They have to prove if giving away equity actually translates to sustainable revenue.
And explain how they plan to address that $8.8 million in short-term liabilities.
Exactly. When they barely had over $100,000 in the bank last time, the volatility leading into that date is going to be intense.
Intense feels like an understatement. It sounds like a powder keg.
Definitely.
So let's quickly recap what we've unpacked today. WeShop Holdings gave us an eye-watering 137% daily surge right up to 1955.
A massive run.
But it's against a terrifying backdrop. Critical cash flow issues, massive debt where short-term liabilities dwarf short-term assets, and meme stock technicals.
Right. Retail momentum fighting a long-term downtrend while the smart money stays far away.
And, this raises an important question that every investor needs to ask themselves when looking at these loud narrative microcaps.
Let's hear it. If a community-owned platform's survival relies entirely on user adoption through this ShareBack model, But the financial runway is so short that short-term liabilities eclipse short-term assets by over 50 to 1.
Right.
Are retail buyers genuinely investing in a company today, or are they just funding a very expensive, very temporary social experiment?
Man, that is exactly what you need to be asking yourself if you are watching WSHP right now. It is the ultimate battle of a compelling narrative versus unforgiving numbers.
It really is.
Thank you so much for joining us for this deep dive into the madness of WeShop Holdings. We love breaking down these complex market anomalies for you.
We really do.
But we also want to hear your take. Please make sure to like this video, subscribe to our YouTube channel, and leave your feedback in the comments.
Tell us what you think.
Do you think the ShareBack model can somehow survive this cash crunch and prove the institutions wrong, or will the gravity of that massive debt pull this stock right back down to the single digits? Let us know.
We'll be reading them.
Until next time, stay curious and keep digging.